10-year Treasury yield jumped above 1.7% last week, 1.7, which was its highest level more than a year. I think it's dropped a little since then. But the yield curve between the 2-year and the 10-year notes were 160 basis points, the steepest since 2015. What do you attribute to this uptick in yields in recent weeks? And what about the yield curve? Could you get into that just a minute?
Sure. So it seems that rates have responded to news about vaccination and ultimately about growth. So higher growth, higher inflation, lower cases of COVID. So it's in effect, there's been an underlying sense of an improved economic outlook, and that has to be part of why rates would move back up from the extraordinarily low levels they were at, back up toward levels that we're more likely to see. And that has been an orderly process. I would be concerned if it were not an orderly process, or if conditions were to tighten to the point where they might threaten, our recovery.
Mr. Chairman, we're all concerned about inflation, price stability. That's one of your mandates at the Federal Reserve. In the event that inflation does rise precipitously and becomes an issue, we hope not, but it could, what tools would the Federal Reserve utilize or have left to maintain or work toward price stability?
Our most fundamental and well understood tools really are for that purpose, for the purpose of guiding inflation. That's really our tools that create accommodative or less accommodative monetary policy. So that's interest rates, and it's also asset purchases. So let me just say, we don't expect the kind of inflation that you talked about, but we have those tools. And if we were to face inflation that moved up and that threatened to de-anchor inflation expectations materially above 2%, then we would have those tools and we would use them in a way to guide inflation back to 2%.
Shepard Smith here. Thanks for watching CNBC on YouTube.